Hello and welcome to Webinar 1, How Does the Forex Work? My name is Jelle Peters. I'm the writer of Forex for Ambitious Beginners, which is available on paperback in the Amazon store and also on the Kindle. I'm a writer for financial media about Forex and financial trading. And I also frequently give webinars and seminars about these subjects. Now, if you have a question about the book, because many of you have already bought it, simply go to forexforambitiousbeginners.com and either ask the question on the website or just shoot me an email and I'll be happy to help you. Now, in this webinar, we're going to look at some simple stuff about the Forex. The reason for this webinar is that I frequently get questions from people who are interested in Forex trading, but they don't know anything about it yet. And they just want a simple answer to a couple of questions. So it seemed like a good idea to have a webinar which answers these questions. So we're going to look at some basic information about the Forex, about the history, the players in the modern Forex, some of the differences between Forex and stocks, how currency rates are determined, and of course some important Forex jargon, because you gotta know what people are talking about when professionals talk about trading. Now, the most basic information about the Forex I can give you is, of course, the name. The name Forex comes from the words foreign exchange. They're a combination of those words. It's also known as FX and currency trading, but really when it's about currency trading, 90% of the time people just say the word Forex. Now, Forex is a global decentralized market for the trading of international currencies. There is no central exchange. Most of the Forex trading, the vast majority actually, is being done by the largest banks in the world with each other. They also have clients which are smaller banks, and they have clients which are brokers, and they have clients which is us. But just to understand, this is an interbank market basically. It's not, they don't have a central exchange like the New York Stock Exchange. The goal of the function of the foreign exchange market is to determine the relative values of different currencies against each other. So we have to find out what is a dollar worth in euros, how many yen do you need to buy 1 euro, etc. It's important to know that the Forex is the largest financial market in the world by far. For instance, the current size of the daily turnover of the Forex is about 30 to 40 times more than the New York Stock Exchange. As you can see from this chart, since 2001, so in the past decade, the Forex has grown from about a little over 1,000 billion a day, $1,000 billion a day, to $4,000 billion a day in 2010. And at the end of 2011, it was close to $5,000 billion. So this really is a really big, fast-growing market, which is why, of course, it's so fastly growing in popularity. Now, I said there is no central exchange, and the opening hours are connected to banks. So if you look at this question, what are the opening hours of the Forex? What do you think? When do you think it's open? Right, it's 24 hours a day, 5 days a week. It's not 24 hours a day, 7 days a week. And the reason for that is that even though this is about banks anywhere in the world, all banks close during the weekend. And it's always, and there is a time when it's weekend everywhere. So if you live in Europe, for instance, the Forex will be closed from Friday night around 11 o'clock till Sunday night when it opens again. But 24 hours a day, which makes it very interesting for a lot of traders because, of course, it's much more accessible than the stock market. Now, the modern Forex only comes into being in the 1970s, which might come as a surprise to a lot of people. Now, although foreign exchange merchants have existed for thousands of years, the real champion of international financial transactions of the past millennia has been gold. Gold has been coveted for a long time, and silver as well. So in the old days, in ancient times, when you had gold and you went to another country, you were sure that you could get some local coins for that. So much so actually that in the second half of the 19th century the gold standard is introduced. Now what this was that in that area, in Great Britain, a lot of banks had their own banknotes, and the British government wanted to end this. So they wanted to give the monopoly to the Bank of England, which then introduced the gold standard, which guaranteed people that when they came to exchange their banknotes, they could get gold for it. This gave a lot of stability to the British banking system, and as a result, other countries followed. Germany, France, Holland, the United States, they all followed and all introduced the gold standard. Now, in the First World War, they have to leave the gold standard because the war is so expensive, but later they get back to it. Then in Bretton Woods in 1944, just a month after the invasion in Normandy during the Second World War, it is decided to peg other currencies to the US dollar and the US dollar to gold. So in effect, there's only one country that has the gold standard at that point, which is the United States. But since other currencies are pegged to the dollar, they also have a lot of stability, which is called the golden exchange standard. This is all because they want to have international stability in the international monetary system. It works very well. Unfortunately, in the 1970s, the United States is forced to abandon the golden standard itself because of the Vietnam War, which is also very expensive. So then the modern forex comes into being, and we get free-floating currencies. Now, in the second part, we're going to have a look at that. We're going to look at the modern forex. Who are the players on the forex? What are the differences with stocks? And how are currency rates determined? That last part especially is very important. So please get back for part 2, and we'll have a look at how things work.